Welcome to BizEdMadeSimple. In this video, we're looking at a popular topic that trips up a lot of people. We're looking at the need for finance and the main sources of finance. You can see everything on my screen that we're going to cover in it. Let's get down to it. So the first thing is, why do businesses need finance? Well, they need it for startup capital. It costs money to create a business from scratch. You can see a hair salon might need 10,000 to buy the chairs and the mirror and so forth. So that's a reason why they're going to need money. Another business might need it to expand. They may have been open for a while, but if they want to get bigger or open a new shop or something like that, they're going to need money to do that. Another reason is replacing an asset. If your equipment that you've got, the asset, if it be a taxi company, if their taxi gets old, then they'll have to replace it. So replacing that asset is another reason why they might need finance or money. Investing in technology. They might need to modernize their company, get it up to date with the AI technology and robots going into it, automation. All of that would cost money to do it. And then finally, they might need it for the work, well, they will need it for working capital, which is paying the day-to-day bills. Now, I've done a whole other video on this section, so I'm going to put a link up here. Have a watch of that. Okay, we then need to break it down. It's commonly broken down into short-term versus long-term finance. I find this section a little bit irritating, but essentially, short-term finance is money that is needed for less than 12 months. So they need it urgently and they expect to be able to get that back in a different way or not need that money tied up for longer than 12 months. Long-term finance, they expect they need to spend some money and they're not going to turn that back into money for a long, long time, well after 12 months. So that's short-term and long-term. It's not the most comfortable of definitions there, but good enough for us. So if we look at it like this, we've got the different ones we're going to be running through where we can break it down into short-term, long-term, internal or external. We'll come back to the words internal or external, but that's going to be hovering on the video screen as we go, and we're going to be covering all of these different things. As ever though, because it's my video, I'm going to love a silly story. So let's get into the silly story to explain all of the rest of the things. We're going to start off with cautious Carla. Now, Carla has always dreamed of running her own cafe, bar style thing in the center of town. But she, although she's a bit of a risk taker because she's starting a business, she errs on the side of being cautious and she refuses, she always has done in my silly story, to borrow money from anyone. She likes to be independent. She doesn't like to borrow money for banks, investors, mum, dad, no one. So she's going to be trying to open this cafe all with her own sources of finance. Okay, let's look at why she needs some money. So the first reason she's going to need some money is to open the cafe. We just used that key term, but she's going to have startup costs. She's going to have to buy furniture, oven equipment, all sorts of things. Now, over on this part of the screen, below me, you should be able to see that when choosing a source of finance, we should think about these different things. The size of the business, well, it hasn't really started, the legal form of the business, the amount that she requires, how much money, the length of time that she wants that money, is she going to pay it back? Has she got any existing debt or loans? The cost of borrowing that money, if she is borrowing it, and the purpose, what's she putting it to? And then she wants to think about this little post-it note of internal and external. Now, she is only going to be using internal finance though, because that means she doesn't want to borrow from anyone. She wants all the money to come from herself. So what should she do here? Well, she thinks about it and she says, I don't want to borrow from anyone. I want it to be internal. So she goes to her owner's savings, her own personal savings there. And this is providing that she has some, and she does. So she breaks open a personal piggy bank to start this business. The advantages of that is that she doesn't have to pay any interest to anyone. She doesn't have to pay anyone back. It's her own money. She's just using it to start her business as probably a sole trader at this stage. This also means she keeps full control over her new business. She doesn't have to owe anyone any favors or ask their opinion, no investors, not even a mum and dad, because she's used her own money. And of course, because it's her own money, it's quick and simple to arrange. She doesn't have to ask anyone. She just says, my money, I'll spend it on what I want. So she does that. The disadvantages though, well, it puts her own money at risk. If the business fails, if her cafe doesn't work, well, she doesn't get that money back. She's got an opportunity cost there that she can't spend it on something else. She can't open another business or go on a holiday, those sorts of things, because she spent all that money on the business. It's also a big problem. It's limited by how much savings she's got. Some people don't have any savings, so they can't open it with owner savings. If she's got 20,000, well, that's the limit on how much she can borrow. She can't do borrow. That's the limit on how much she can use. If it's not enough, then that's it. She can't use it. Then we move along in the story. Now, Carla needs money. She's not been handling things very well in the restaurant, just to start with, in the cafe, just to start with. She's been ordering a lot of inventory. She's been buying lots of coffee beans. And to keep her customers happy, she's been running tabs. And she'll say, yeah, no problem, you can pay me next week, and those sorts of things. But that's putting her in a bit of difficulty because, of course, she has to pay for things. She has to buy coffee beans. She has to buy toilet roll for the toilets and so forth, and she's been struggling to pay her day-to-day expenses and got low working capital. So she has a think, she goes through the list, what can she do? She doesn't need massive amounts, but she does need to be on top of her daily money. So she thinks, you know what, I'm going to sort this out. I'm going to manage my working capital better. How does she do that? I'm going to go to the disadvantages first. Well, she says, I'm going to reduce stock. I'm not going to order 700 bags of coffee because that's just going to sit in the inventory in the storeroom, blocking the storeroom, and it's not going to turn itself back into money until the customers buy cups of coffee. So she's going to reduce the amount she's going to buy, maybe just-in-time inventory management from Unit 4 in most syllabuses. She's also going to, but that's a problem because if she runs out, because we're doing disadvantages, if she doesn't have enough, she's going to run out and upset the customers. She's also decided no more tabs. I'm going to ask the customers, sorry, you've got to pay straight away. When you drink or eat here, you have to pay. You can't pay me at the end of the week. Good, it's going to have more cash coming in faster, but you're going to upset them because they would have been used to paying at the end of the week. She could also risk delaying payment to her suppliers. The people who buy the coffee, she could say, yeah, I'll pay you, but she actually pays them a week later. All that would help her have more cash to spend, more working capital there. Watch the video just to check on that. The advantages of that, because I did disadvantages first, well, that would free up cash quickly. Pretty easy. She doesn't owe anyone any money. It just means she's got more cash available. It improves the day-to-day cash flow. And of course, there's no interest because she's not borrowing from anyone. Let's go on in the story. Now, time goes on, Carla's doing well, but she needs money to renovate her kitchen. Maybe a couple of years have gone by and she needs a brand new shiny oven. And they're expensive ovens and she thinks, where am I going to get the money to buy this oven? She checks back against her factors to consider how much, what's she putting it to, and she has a think, you can have a think as well, and she decides, I don't want to borrow from someone else, I know what I'm going to do. I'm going to sell an unwanted asset. Because actually, she's got an old oven. Now, it's not entirely broken, we'll say in my story. It'd be good to have two ovens, but the old one was fairly small, and maybe she can sell that asset, the old oven, to buy the new one. So that's what she does. The advantage of selling the old oven and using that money to put it towards a new one is it generates cash without borrowing. She doesn't have to ask anyone for any favors. She just sells her old oven. It also frees out some space. It clears out the old oven that she's not really using and she's not too excited about, and that's a good thing for her business. Again, because it's internal, she's not borrowing from anyone. She doesn't need to repay with any interest to anyone. The disadvantages, though, of course, it's only possible if she's got a spare old oven. If the old oven's broken, well, you don't get any money for it. So it's not for everyone. You have to have an asset that's sitting around that you can liquidate and turn into cash. Often the amounts are fairly small that you get because how much money are you really going to get from this old oven? And of course, it may take time to find a buyer. You've got to put an advert out there and hope that someone is going to buy it. I think finally in this section, we now have Carla is doing really well, but she wants to expand. She's making good profit, but she wants to create an outdoor seating area. So she has a think, what source of finance? She doesn't want to borrow. She only wants to use internal sources of finance. So she goes down her list and she says, okay, I'm going to use retained profit. Now, this isn't her owner savings. This isn't her own money now. The business has been running for 3 or 4 or 5 years. And over that time, we would hope, not only has it been like covering its costs, it's been making money. And in the business bank account, perhaps, particularly if it's a private limited company, it should have amassed some money of its own. Well, that we would call retained profit. Well, then use it, of course. If she needs money, rather than using her own personal money, she can use the business's money, the money that's been left behind. So what she does is she can spend that to buy the seating area, and the advantages of that is it's a completely free source of finance. You're not asking anyone for permission. It's the business's money, so you don't pay any interest either. The disadvantage is, well, that's not available when she just started. It takes time to build up retained profit. Also, it reduces what Carla can take out as personal income. If she spends it all on refurbishing a kitchen, then she's got less to take out of the company and give to her own bank account and look after herself. And again, the same problem that we can put for most of these. Maybe it's not enough. If she's only been open for a year, it might not be very much money at all. So it's on the proviso that she's got enough retained profit to use it. Now let's go for a second silly story and introduce another character. Now I'm going to introduce Risky Ryan. Now Ryan is a builder, but he wants to start his own construction firm. However, unlike Carla, Ryan loves taking risk, and he has absolutely no problem borrowing money from other people. He's quite happy to do that, and he'll pay them back when he can. He's very casual with those things. So for him, he's all in favor of external sources of finance. He does not mind borrowing, whereas Carla wanted internal sources of finance, money that she's generated herself. He doesn't mind borrowing. So let's get into his story. Well, the first thing, Ryan needs money again to start up his construction firm. Not massive amounts to start, but he needs about £15,000. But he's got no savings. Unlike cautious Carla, he's got absolutely nothing. So he goes down this list, where can I get my money from? He looks at all of these different things, he has a think about it, and he says, well, I know what I'm going to do. I'm going to go to the government. I heard about something like this. They give grants. Now, G of grants for G of gives. Yes, governments give money. They don't just lend, they can do that too, but grants are given. It's a great thing. But obviously, they don't just give them to anyone. You've really got to justify why they should give you some money. So he goes off to the government, goes to the town hall, and he said, look, I'm going to set up this construction firm, and I'm going to help people out. I'm going to create jobs. I'm going to make more houses. And if the government's on board with that, if they say, yeah, that does sound like a useful thing, ultimately we could win in this, we will give you some money. So in my story, he was lucky. He promised to employ local people, and they gave him $15,000. The advantage of this, it's free money. You don't even have to pay back repayments. So you haven't even got interest. This is money that is G given. So that's excellent. It also improves credibility and it meets policy goals. You could say an advantage of that, if you've got a grant off the government, it shows you're fairly reputable because you will have had to have jumped hoops and the government won't just trust anyone. You can also unlock further support with that. If they give you the money, the government's probably going to want to make sure that you're not wasting it. So they'll probably open up some training courses for you as well. Keep connecting, checking in on you, saying, hey, do you need any help? Because they want you to employ the local people. The disadvantage is, though, it's often very small. They're not going to give hundreds of thousands in government grants, about 10 to 15,000 euros. It's also a disadvantage. It's very, very competitive. You're not likely to get it. If you want to open up a company that isn't particularly ethical, then the government is unlikely to give it. And lots of people are applying for these grants. Thirdly, strict conditions on use is a disadvantage. We talk about strings attached often. The government say, yeah, we'll give you this 15,000, but you do need to employ local people. You can't then fully just go, well, actually, I don't want to employ anyone. No, you've got conditions to meet. Otherwise, if you break those, you might need to give the money back. Ryan's story moves along. Now, in this bit, he's getting up and running with his government grant, but he's got his first job. He's promised to build something, but he needs 8,000 to 12,000 in bricks and cement, and he hasn't been paid anything yet because as a builder, you don't get paid in advance. So he needs to buy the bricks first. So he thinks about it. Where am I going to get this 12,000 from? He goes down his list, and in the end, he thinks, I know what I'm going to do. I'm going to use trade credit. Because he's been a builder for a while, he's got some mates in there, the people who sell bricks. So he goes up to one of his mates and he says, look, I need to buy bricks. I need loads of bricks, but let's make an agreement. We can write it down if you like, or we can shake some hands. I'm going to make it, but can I pay you back in 6 months' time? Now, you might say, why would anyone do that? But the person who sells bricks would probably have to get used to doing that, because many people would be in this situation. He might not like it, but he probably would say yes. And even better, he probably wouldn't charge interest, because it's in his interest for him to be in line with Risky Ryan. Because if you sell bricks and Risky Ryan's a building, it's a good relationship for a brick seller to have with a builder. So they form a relationship, and he says, okay, you can take the bricks now and pay me in 6 months. The advantage of this, you don't pay interest typically if it's on time. Unlike a bank that we'll come to would charge you interest, his mate, the brick seller, wouldn't charge him interest. You can match cash outflows to job timing. So by that we mean that he can pay for the bricks once the customer who wanted their house built has paid him. So he wouldn't have said in a week because he wouldn't have been paid yet. So he said 6 months because he thinks the house will be built by that point. It's quick to arrange with known suppliers. They'll probably get caught up in that deal next time. He won't have to negotiate 6 months. He goes, same again? Yeah, same again. So it's often pretty quick. The disadvantage, you probably won't get away with early payment discounts. These brick companies will probably give a discount if you do pay straight away, because they really want to be paid straight away for their working capital. So you would miss that. If you don't pay them after 6 months, then you're going to break a relationship and maybe they won't sell you bricks anymore. So they may stop if it's late. No more bricks coming to you. And of course, you can't do this forever. You can't say it's not suitable for long-term funding. You can't say, okay, can I get the bricks and I'll pay you in 17 years? They're going to go, no, I need the money. So we've got some disadvantages. On to the next situation then. Ryan now is needing a van, but he needs 24,000. The van he's seen is £24,000, and he just doesn't have 24,000 early on in this in this business. So what does he do? He goes down his options, he looks at those, and he says, okay, I'm going to buy it with hire purchase. What does that mean? Well, it means that you buy the car, but you pay it off in the van, but you pay it off in installments, not just all at once. You drive it away. It is your van, but you don't have to pay it all at once. But they come with some conditions here. The person selling the van, the company selling it. So it would probably start, he would need 2,400, we're going to say. These would probably be the typical conditions of buying a van. He'd have to pay outright 2,400 with hire purchase. Then he would need to finance, pay off the rest, 21,600, over 60 months. So that would mean he's paying off 418. This will be very, very useful for your cash flow forecast. Watch this video in another section if you're not sure on that. But that would be a total paid, including in the end, 27,456. So although the van only cost 24,000, he ends up paying 27,456. What's the advantage of this? Well, that's fantastic for helping out with your working capital. It spreads the costs out in installments. It also means it is his van at the end of it, and even you could argue before, it is his van. By the end, after 6 years, or 60 repayments, sorry, that is his van. And it's quite nice that it's predictable. It's 418. That's useful when you're doing cash flow forecasts. The disadvantages, though, he has to pay 3,420 more than you would if you just paid the cash up front because of the interest on the payment. Secondly, if you don't pay it back, if you miss a payment, well, then you've got a risk. That company's going to take the van back, and if you haven't got the van or you damaged it, then you can be getting yourself in all sorts of other problems. So you're under risk there. And the worst bit, even if the van breaks after a year, you still have to keep paying for 60 months because that's the amount you have to pay. So very, very difficult. Next in the story, Ryan's business is going well, but he now needs a large digger, and that's 70,000. So he goes through his factors, how does he decide? And he comes across this option. He says, well, I'm going to lease it. Now, seems a bit similar, but it's not the same as hire purchase. In this one, is essentially, it's kind of like renting, but he is therefore going to pay a monthly installment on this, but he's going to pay it over a long period of time. He's going to commit to it. Unlike renting, which can be fairly short term, it's long-term commitment to renting where he has to pay $1,300 every month. But unlike hire purchase, it is not his tractor or whatever that thing is. The never will belong to him. So he would have to draw up an agreement with this company, the leasing company. Okay, I want this for 3 years and I will pay you $1,300 every month. At the end of 3 years, he can either keep going with that or he can say, I don't want any more. But if he doesn't want any more, well, they take the tractor back off him. So it's just a way of not having to pay the $70,000 outright, but he does have to pay $1,300 per month. So the advantage of this is no upfront payment. Very good at helping with your cash flows. The maintenance is often included in that. This time, unlike the car, if it breaks, if the tractor breaks, that's probably up to the company that's leasing it to you to have to fix it. So you don't have to worry about the maintenance so much. And if the tractor, you say, well, this is a bit old, then you can get an update because you say, well, I'm paying $1,000. I don't want to be tied to this old one. There's a new one that's just come out. Can you swap it? And you can do that. So you can keep up to date with the new equipment. The disadvantage is, well, it's a higher total cost over time. You're paying $1,300 over the course of 3 years, and you don't get anything for it other than the use of this tractor thing. The third disadvantage is, you're tied in even if usage falls. Because you've had to have committed for 3 years, if after 2 years you're not really using it very much, well, tough. You've got to see out the contract that you've signed up for, the leasing contract. Next part of the story, Ryan's van breaks down and he needs an emergency repair. This van that he bought on hire purchase, he has got $1,000 on it. Now that's not a lot of money, but the problem is he's not actually at this point in my story managed his working capital very well, and he's only got £500 in his business account. But he needs to fix the van straight away, otherwise he can't get to work and do various things. So he has a thing, I'm short here, I'm €500 short. Where am I going to get this from? But I'm not short for very long because money's going to be coming in next week. So what do I do in the meantime for this 500? Well, in this case, overdraft is a fantastic choice. What is an overdraft? Well, it's set up by banks and you can ask for it. Most of the time they'll give it you automatically, but if not, you can ask for it. And they say, will you let me spend more than I've actually got in my bank account? Sounds crazy, but they will let you do that. So if you look at this machine here, this seems bizarre, but it would say balance. How much money have you got in the bank? 500, but available to withdraw 1,500. In other words, they will let you go to minus 1,000. You've actually got 500, but they'll let you drop down to minus 1,000, letting you go there. Okay, what's the advantage of this? Well, it's fast and flexible and easy to cover short gaps. You don't have to ask anyone. You just type in the ATM like that, and instead of getting out 500, you get out 1,000. And the bank balance next time will show minus 500. So no need to call anyone, quick and easy. The interest is only on what is used. So if you went down to minus 500, but you were only there for a day, you would have to pay interest, and you'll see that's quite high, but you'd only pay on the minus 500 for the period of time of 1 day. So you want to use it for short term. It's simple to draw down and repay. It's very easy to do that. The minute he gets paid, if he gets paid the next day, that money goes straight back up again. No dealing with anyone, nice and simple. The disadvantage is, it says, the interest is high. You do not want to stay in your negative numbers for very long. So you'd be using this over a short period of time, a week, maybe 2 weeks, but interest is high if you're going to stay in negative numbers. It can be another disadvantage. The bank, you might just pull it away. They might just say, no, you're not having an overdraft anymore. So you were relying on it, and the bank says, no, we don't want to do that with you anymore. We don't trust you. And the main thing, it's only for small amounts. You cannot go with overdraft to minus 17 million. It will be small amounts they'll allow, and you don't want to do it for long periods of time. Next part in the story, Ryan now is getting bigger and he wants to run several projects at once, but he needs 100 to 200,000 for this because he needs to hire more teams and buy big intensive scaffolding. He has a think, where's he going to get the money from? And at this point he says, well, I should have gone there earlier. I'm going to go to the bank and I'm going to borrow. I'm going to have a bank loan. So how does this work? He goes to the bank, he has to show maybe a business plan, and he says, I would like to borrow from you 150,000. They then would negotiate some terms, but in this one they said, okay, you can borrow 150,000, but we're going to put 6% APR, don't worry about the term, but that's interest, compound interest it would be for those technical ones, but don't worry if not. So, and they'll say it'll be 6% interest if you want it over 5 years. Well, what does that mean then? He borrows from the bank £1,500, but banks don't just do it to be nice. They're a business, they want to make money. So they say, well, if you do that, if you borrow 1,500, you are going to have to pay us back 2,900 every month for 5 years. If you think about that, go, that doesn't add up to 1,000. If you pay 2,900 for 5 years, every month for 5 years, you end up paying back 174,000. So you've paid an extra 24,000, which of course is why the bank does it. The bank makes £24,000 out of you. The advantage of that, well, it's great to get large amounts of money in one go. They will lend you fairly large amounts of money. It's multi-year term matches, that sounds complicated, but that's good because you can take it over a long period of time. So if he needs this project and he knows he's not going to be paid for a couple of years, well, that would work okay with that, and then you've paid it off. You've got a fixed schedule. Again, that's very, very useful when sorting out your cash flow forecast, to know it's a fixed cost. You know every month you're going to have to pay 2,900. The disadvantages, though, you end up paying back more. We've got the interest, that's 6%. You end up paying back 24,000 more than you actually borrowed. You may require collateral. Often you'll require. Now, what does that word collateral mean? They're not just going to let Ryan walk out with 150,000. They're going to say to him, okay, you can borrow this money, but what have you got to put against it? So he might have to put a house or his car or something like that up, because they say, if you don't pay it, if you don't give us back that money, we're going to take that asset off you. We're going to take your house off you because we want to make sure you pay. We don't want to hear, oh, I haven't got it, I can't pay it. Well, we'll take your house and then we'll sell that to get our money back. So that's called collateral. So high risk. It's very risky if profits are lower than planned, because if you default on those payments, the banks aren't waiting to be kind. They are going to say, I want that money back. You owe us 174,000. We're going to take whatever you had as collateral. They're going to be pretty brutal and damage your credit rating, stopping you from being able to borrow in the future. Next, Ryan now gets even bigger, all going well, but he wants publicity and cash for Eco Homes pilot. He needs about 60,000. So he wants to get all ethical. He wants to do an Eco Homes. He doesn't want to borrow again from the bank though, because he's already got existing loans. He's used quite a lot of these things. So he thinks, where do I get this 60,000? Well, he comes across an interesting one here, and he comes across crowdfunding. Go and have a look on a website. This is a real website here. Lots of my children can't believe this thing exists. But yes, there's like GoFundMe, where he can just go on. This is real. I just took a screenshot. You can go on and say, I'm running a business, but I want to do something. It doesn't even have to be good if you don't want, but will you give me some money to do it? It's a bit more complex than that, but essentially it's saying, I want to do this thing. Will you just give me some money? It's sort of like online begging, as it were. And you can see, so on here, this person wants to build free parking and she's raised 25,000. Again, that's a screenshot, so this really is real. So he could do that. I want to build eco homes to help the world. Hey, who wants to give me some money to do this? To give me some money. Just donate, give. I don't have to have anything back, just give me money. Great if you can get it. The advantage is it, well, you get finance, you get the money, and you get marketing buzz, because you get an audience who's excited about this, and they might spread the word on social media. You'll have access to small backers. You'll have lots of people hearing about you and chipping in and giving money. It's useful market validation. It's good to let you know, they're a bit complicated there, but it's good to let you know, this is going well, right? This is a good thing that I'm doing. Often the advantage though is, it doesn't say that, you don't have to pay it back. It's given. Not always, we have to be careful with that, but often the money is just given by these people. So it's free money. The disadvantages, well, the biggest one, are you really going to succeed? It's unlikely. Lots of people try it and get absolutely nothing. So yeah, if they can get it, but you probably can't get it. You're going to struggle. Next disadvantage, it takes a lot of time and effort to promote it. Yeah, you've got to be creating a good page, you've got to be spreading the word on your social. Come on, donate, it's great. And thirdly, your ideas become public. If you've got a rival, they might start copying you. So you can't keep anything too secret if you're going begging for money from people. Next, Ryan's doing really well and it's got even bigger now, and he wants to go for a high growth eco estate but needs a lot of money. He needs 500,000. So he again looks at his list, existing loans, the length of time when he's going to pay it back, and he thinks, I'm going to go for venture capital. Now, this is kind of like the Dragon's Den or Shark Tank if you've seen it. Great program. You should, as business students, be watching that. But this is where he goes to an investor, a venture capitalist, and he goes and says, look, I need 500,000. Will you give me 500,000? And as a return from that, I will give you a percentage of the business. You will become a percentage owner, and therefore you will get a percentage of all of the future profits and wealth of the business. That's what happens on Dragon's Den. You can go and watch it. They'll explain far better than me. But what are the advantages of this then? So the advantage is you can get large investment plus expertise and contacts. That's one of the things when you watch the program, you say you're not only getting the money, you're getting my expertise and you're getting my connections with the supermarkets or whoever it may be. Other advantage, you're sharing risk now with the investors. These investors, because they've put this 500,000 into it, they risk their money too, and they're going to want to help you out, so it's not risking that money, so it does succeed. They will help you with all their expertise, accelerate the scale up. They will help you grow more rapidly. The disadvantages, though, there will be significant loss of independence. You're going to have to ask these dragons now what's going on. Well, not ask, but they're going to come over and, depending on how much of a share they've got in your business, they're going to be looking over your shoulders saying, what are you doing? Why are you doing that? So you're going to have to answer a few questions to these venture capitalists. There'll be pressure for high growth and high returns. These venture capitalists will want lots of money. They didn't give you money for the fun of it. They're going to want to give you money and get fast money back. So they're going to be putting pressure, going, no, come on, what are you doing? I want another investment, build something else. So they're going to put pressure to make you keep working. And of course, it's going to be the dilution of your shares, the dilution of owners. If you give 10% away, you might only have 90% of all of the business profit and wealth in the future, and they keep 10% of that. Finally, I believe the last one, in this situation, Ryan now has gone really big with the help of the dragons, and he's converted to a public limited company, which have a look in Unit 1 videos or this video if you want to see what a public limited company is, because it's important here. But he wants to plan regional growth, so he needs masses of money. He needs millions of pounds. Well, he thinks about that. Where am I going to get my millions of pounds from? Well, it's not going to come from an overdraft or something like that, small amounts. So he decides upon the stock market. He decides, as he's a public limited company, he's floated, and therefore he can issue shares. Not just sell shares to a dragon or a friend and family as a private limited company can be, watch the video. He can now sell shares to the general public, where the public of public limited company comes from, and they can buy a little piece of his business for a cost. You can sell millions of these shares and therefore raise millions. That's a longer video in itself. But as a source of finance, what's the advantage of that? Well, you can raise large sums of money. You're not going to raise 20 euros with this. This is for large amounts of money, millions of pounds usually. There are no repayments. When someone invests in that company, you don't have to repay them. That is money they part now, a tiny, tiny owner in your company. You don't repay them. But because they own part of the company, then they will get payouts from the company, and those payouts will be dividends. So if you want to pay out and you've given away 40% to shareholders, if you want to pay yourself out 100 euros, be far more, but if you pay out 100 euros from the company, 60 euros would go to you, and you'd have to pay 40 euros to all of the shareholders as dividends. The disadvantages of that, there'll be some loss of control is possible depending on how many shares you give away, but it's easy as a public limited company to lose track of that, and you might find that you're not in control as much because before you know it, you're not the majority shareholder and you've got a board of directors getting you to do things you don't want to do. Like with the last one, the venture capitalists, the shareholders expect returns. Short-termism, we call it. They are looking for money to turn into more money. They're not really interested, these shareholders on the stock market, in whether you build houses. They just put money in the hope that it will become more money very quickly. So they'll be putting pressure on you to just make more money. And you're absolutely going to have legal and reporting requirements. If you are a public limited company, then you're going to have to be enormous cost as well, declaring everything that's going on and representing it and having annual general meetings and so forth. So that is only for a certain type of company. That ends sources of finance. It was a long video. I hope it helps. As I said at the start, any questions, just write them in the comments and I'll happily help.